Welcome to the July 28th, 2025 Advance Report for McGowanGroup clients and NetWorthRadio.com listeners. What a week it was! So I'll tell you the story and then I'll give you what we believe is ahead and what we're doing in the portfolios. First, a new high every day this week on the S&P 500 after the announcement of the trade deal with Japan. And you see this pattern all the way from the tariff liberation day, which melted down the markets because Trump went wild on the entire planet with tariffs. Wow. But the inflation didn't materialize. Inflation hasn't gone up much. It hasn't gone up at all, actually. It's actually down over the past four-year low for inflation. At the same time, I'll show you corporate profits here in a second. But we had this huge melt up really fast. You want to beware. The S&P 500 is now up 9% year to date. That is a wow. And it may be unsustainable, and I'll tell you what outcome and what to do about it according to what we're doing in McGowanGroup Wealth Management portfolios. I'm Spencer McGowan, your financial weatherman, President, McGowanGroup Wealth Management. We serve affluent families right here from the Crescent in Dallas. Be happy to do a plan for you. There's just a $2 million minimum, and we'll put your plan in place. Just go to networthradio.com, contact us there. All right, 8%, that's the growth in the S&P 500 companies over last year. So out of the 1/3 of the S&P 500 that have reported, 8% is the growth rate over last year. So far, so good, but that's a little anemic compared to the 12-month gains of the equity markets. Are the equity markets overpriced? And what should we do about the more generous pricing of companies? Well, in this case, this is how much you pay for the trailing 12 months of the S&P 500. And you could see, we go all the way back to 1996. That's a 30-year chart. This is high. This is low. That's high. This is really high. What does it tell us? Well, you go back to 1997, and that is the time that earnings were exploding. You had the PC revolution, the efficiencies from the internet adoption, and you had a long boom, much like the AI revolution that's happening right now. But we're in anticipation mode. 27 times the trailing 12-month earnings. That's elevated. So what do we do about it, and what are the potential outcomes? Let's look at what's working the last 90 days. Then we're going to go into strategy. There's a huge speculation in this market, and I'm going to end with some funny speculation in really crappy companies. You can take it as a warning. But Coinbase, well, that's all about Bitcoin. Bitcoin hit 20,000. You're in a 120,000. You're in a speculative frenzy. And Coinbase, which is a crypto exchange, up 86%. Wow. Seagate Technologies, STX, up 84%. Oracle finally woke up 74% in the past 90 days. Now remember, 90 days is after the April meltdown, right? Since then. So you got some pretty incredible numbers. Western Digital. GE Vernova, that is the equipment to make the power to power the data centers. Advanced Micro Devices, 68%. Wow. And you got some cruise lines in there. I'm not sure why. Royal Caribbean, Carnival. Anyway, so those are the big gainers. Who's bringing up the rear? Centene reported a loss. Molina Healthcare at the bottom of the barrel. Texas Pacific Land. That's nearly 1 million acres of Texas land. It had a great year last year, gave back part of it. Enphase Energy, the solars just got smoked. And that's because government subsidies are not really going to happen for solar and for wind. How are they going to power those data centers? It takes a long time to build a nuclear reactor. That's one of the answers. In the meantime, natural gas is the answer, and the pipelines, well, that's the way the gas gets to the power generator. Simple answer on allocation, and it fits right here in growth and income. Energy infrastructure pipelines make up a key part to that. Global lending, high cash flow. There are opportunities for 6, 7, 8, 9, and even 10% in global lending that's well managed. Okay, that makes sense as a permanent part of the portfolio. Growth with innovation. That's what's driving the big gain in the S&P. There are areas, good dividend companies, that are not as overpriced. Still, this is a great time to take profits. Here's the other side to that. If it ain't working right now and the S&P is at a new high, you start to harvest, right? Let's say I've got something at a big gain. I'm going to harvest part of that. But the other thing I'm going to do is I'm going to look at all my slackers. And if it's not at a nice gain this year, then I am going to either move it to safety and income by selling it, or I'm going to put some sort of alert or sell stop that says if it breaks support, I'm out. And we did that with some of the portfolio holdings, weeding out, taking some profits. I want my safety and income restored. We told you this right here, which is why you should subscribe, in the fourth quarter and at the start of 25, that in our managed accounts at McGowanGroup, this is one reason you should be a client, we were favoring tactical safety. What did we do with it? In the April meltdown, and it was basically a first quarter meltdown that culminated in early April, we were adding great dividend companies for this category. Now we're going to restore more tactical safety. What's the other outcome? There is a 27% projected gain, 26, 27 for S&P 500 earnings. It would put the S&P at 18 times earnings instead of an elevated 27. You could go sideways in kind of a stealth bear market with some downdrafts and updrafts. You could basically be at the same place in 2 years, and you'd have a market that's more normally priced. You want dividends and cash flow during that period, and you want to strategically use safety and income. That's what we do in our portfolios, and it cash flows. So if you're retired or about to retire, you can pay the bills and still have some money left over. Now, this is a to not to. This is something you don't want to do, in my opinion. And if you want to do it, you better have an edge, okay? So GameStop. This is a really crappy company with stores that nobody goes to, and they lose money on the stores. Well, the hedge funds had shorted it, meaning they borrowed stock to sell, but eventually they got to buy it back to close out the trade, hopefully profitably. Then all the Reddit bandits and Robinhood bandits figured out how to do an alpha squeeze, start buying the stock, pushing the price up artificially, and the hedge funds had to buy to cover their position, and GameStop went way up. They sold a bunch of stock on top of the investors. Now, instead of running crappy stores, they say, oh, we're just going to buy Bitcoin, which that's a pretty bad strategy in itself. So obviously GameStop came back down from 400 to wherever it is today. All right. Now, this is another to not to. Krispy Kreme. This company's already been bankrupt once, by the way. So it costs about $2 million to do a franchise. You burn electricity all day. You make money 2 or 3 hours, and you just sit there burning cash for the rest of the day. It is a burning ring of fire, to quote Johnny Cash. Whoa, they went down as low as 250, and then they bounced back up. Now, there's Krispy Kreme, 250, and then they bounced up to 6. Now they're 4. I don't think this one's going to 400 because that company is bad. You've got little donut shops all over the place that have no debt. And here you got a bunch of debt-laden franchisees paying big money to Krispy Kreme. This is a bad equation, and there's better donuts at the mom and pop shop down the street anyway. All right. Whoa, what's this? Beyond Meat. This is a great idea, right? Nobody wants to eat meat, which is actually not true. So they take vegetables and they turn it into something that looks like meat. And of course, people that are more natural, they don't like processed foods anyway. And this is kind of ultra processed veggies with some stuff in it. And it's a bad idea. Company really doesn't make any money. They went down to $2. Then they went to $5 because all these traders piled in. And there's videos out there saying how, oh, we're going to run this one and run this one and the hedge funds are short. Well, I think that's a waste of time. What you want to do, come down, get a plan from McGowanGroup Wealth Management for the core assets that are going to pay you real cash flow for the rest of your life with appreciation potential. You just go to networthradio.com. You can contact me there. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You can see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the Longer Play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.